All right, so now, December 2021, which question? Page 8. Page 8. So let's go to page 8. Let us go to page 8. Already there. Some people are making noise online. Beatrice, una leo nimekuja mapema. Wacha uende wenye hii. Efar ni jambo when you are. Event is being started when you are there. So next 2021. So it says, and I read, the following extracts are from the consolidated financial statements of Eurogroup for the years ended 30th September 2020 and 2021. The group statement of profit or loss and other comprehensive income for the year 30th September 2021. As you can see there. Also, there is group statement of financial position, which your eyes is capable of seeing around there. Good. Additional information. 1, during the year ended 30th September 2021, Eurogroup acquired an 80% equity interest. Kindly underline the word acquired. I told you that in this section, you will get a question whereby either cash flow question is either a subsidiary has been acquired or a subsidiary has been disposed. So I can quickly see that last semester they examined acquisition. That is not a direct. That next will be disposal. They can still bring acquisition, no problem. So, acquired an 80% equity interest in Sporting Limited, a local subsidiary quoted in the Securities Exchange. The purchase consideration on acquisition comprised the share exchange of shillings 2,000 million and cash consideration of shillings 500 million. The market value of the parent entity shares was shilling 16 at the time of acquisition. Okay. Sport Limited net assets at acquisition had the following fair values. So the net assets, how much is that? How much were the net assets in aggregate? 2,500. They took all the assets, then they subtracted all the liabilities. So the net assets on acquisition was 25. It is the group's policy to measure the non-controlling interest in subsidiaries at their proportionate share of the net assets at acquisition. Depreciation charged during the year ended at 30th September 2021 amounted to 1240 million, and an impairment loss of 535 million was recognized on the PPE. Prior to the impairment review, the group had a balance of the revaluation surplus of 625, of which 250 million related to property impaired in the current year. Goodwill was reviewed for impairment at the reporting date, and the impairment loss reported in the profit or loss. Eurogroup operates a defined benefit scheme. A service cost component of 300 million had been included with the operating expenses, while the net interest cost of shillings 40 million has not been accounted for. The remeasurement component for the year 2021 was a gain. So that's actually a gain of shillings 40 million. Benefits paid out of the scheme was 380. Required a consolidated statement of cash flow. So if you can't have one cash flow now once, you have to read all of it because maybe they dictate a method. So a consolidated statement of cash flow for Euro Group for the year ended that using the direct method in accordance with that cash flow, 20 marks. So we have to start. Online, I don't know, is there too much lighting here? I'm talking a lot of lighting at that space. I don't know. So write the name there. Their name is who? Euro. So right there, Euro Group. Shilling tariff. Millions. So operating activities. Operating activities, of course, you start with operating activities. Operating activities. You start with which profit? After or before? Yeah? Before tax. Again, after tax, here it means umevuka operations. Operations is just within. So you give us profit before tax. Inakuwa kazi ya macho na inakuwa free tick. So can you look for it in the profit account? Search for it in the profit account. Yeah? Are you seeing it? Profit before tax. Are you seeing 2350? Please bring it here. Listen to this. When we talk of operations, operations are those daily activities which takes place in the organization. So the activities, they can either be income or they can be what? Expenses. So for income, the only operating income, what we get on daily basis is what? Sales revenue. So any other income which you will come across which is not sales, what do? You subtract, because it was overstating the operating what? Profit. When we go to expenses, the only operating expenses we know are these ones here. Cost of sales, administrative, selling, and what? Distribution. So any other expense in that question, which is not these ones here, that one had understated the operations. So what do? You add back. Is that simple? So once you get us the profit before tax, you adjust. So you say adjust for by the way, is your friend. Online. Nancy, online. Yes. So adjust for, you can adjust for any cash flow in this one, and you can get depreciation. You only number one. It will always be there. After anybody who starts with adjustment in cash flow and adjustment and depreciation is gambling. So depreciation, tafuta hapo kwa hiyo swali. You want it back. Why? Two things. It is not an operating expense. We don't incur that on daily operations. Number two, there is no cash which went out. So add back. Let's get depreciation somewhere. Not number two. Depreciation charge during the year was 12 what? 40. So give us here 12, 40. You add back. So once you write depreciation has a close sister. Who is the sister of depreciation? Impairment. So impairment is the close sister of depreciation. They are treated in one and the same way. So in that note number 2, I think there was something. Check note 2. Check that note number 2. They are saying depreciation that and an impairment loss of how much? 535 was recognized in the property. Prior to the impairment, price means before. Prior to the impairment review, the group had a balance on the revaluation surplus of how much? 625, that's the valuation, of which 250 million related to property impaired in the current year. So the property which has been impaired by 535, it had also a revaluation surplus of 250. So now what it's saying. So revaluation is a loss. And at the same time, that asset was done what? Revalued by 250. So net off. Yes, we accept impairment was 535, but that asset which was impaired, they are saying at the same time it was revalued by how much? 250. So reduce the impairment using that revaluation again. So how much is that? 285. 285. Then goodwill. Other usually molecular unique depreciation of property. Mostly goodwill is the one we assess impairment. So I want us to assess and check whether goodwill was impaired. So I have a small working outside there. I want us to reconcile goodwill account to know whether there was any impairment on goodwill. So right there, goodwill. So we want to reconcile goodwill account. I want us to reconcile goodwill account to check if there was any impairment. So how much was the value of goodwill at the start of the year? Goodwill will appear on current assets. So check your non-current assets. How much is the value of goodwill at the start? At the beginning, the value of goodwill was 1,800. Then we acquired a subsidiary during the year. Sure. When you acquire subsidiary, so tunaangalia goodwill on acquisition. So can you check this subsidiary came with goodwill of how much? Then we asked the one which was there at the start. So check note 1. So subsidiary subsidiary, you just check the purchase consideration minus the net assets. So we read the entire note 1. During the year, Eurogroup acquired 80% equity interest in Sporting. What is that? 5. The purchase consideration on acquisition comprised what? A share exchange of shillings 2,000 and cash consideration of 25 or 5. So it is 2 plus 5, giving you 20 what? 2,500. Then there is a small note before note 2. Focus on that note. It is the group's policy to measure the non-controlling interest, in subsidiary at their proportionate share of the net assets at acquisition. You know that is full method. Proportionate share of the net assets. So how much was the net assets? You have to part of the fair value of minority. So net assets was 25. So if they say that which they are talking about, then it means minority, their fair value is 20% of the net assets, which is what? 25. So take what parent invested plus the fair value of the minority. What parent invested plus the fair value of minority. Then subtract the net assets. You know the net assets. So net assets we don't apportion because it is full method. Net assets was how much? 25. So here let us go for 20%. How much is that goodwill? 500. So goodwill is 500 on acquisition. Let me not confuse someone. You know, full method, we take the purchase consideration of the parent, then we add the fair value of NCI. So what is happening? They denied us the fair value of NCI, but they directed that fair value of NCI is the proportionate share of the net assets of the subsidiary. So net assets of subsidiary was 25. So take 20% of the 25. So this is the fair value of NCI. Add to the purchase consideration, then subtract the net worth asset. Meaning, when we are closing the year, goodwill should be how much? 23. This plus this, because we started with this, we topped up this one here. But check what the examiner is saying at the end of the year. According to the examiner, at the end of the year, goodwill is how much? Goodwill is 21.75. So that drop in value of goodwill is what? Impairment, which they are not communicating. So this is impairment. So when assessing a impairment, please always check goodwill in any cash flow. So impairment comes to how much? 125. That decrease, that is how we get the impairment of goodwill. In Agonga Raisi, beginning subsidiary, compare with the closing. So I hope everyone has seen that. So you come here and say impairment. So let's use property. So this one is impairment on goodwill. So impairment on goodwill, we have gotten 125. That one also you add back. That one also you add back. Aye. Then now, check in the question if there is any expense examiner is saying was included in either administrative cost of sales or selling and what? Distribution. I think there is one I heard. Number 4, I borrowed number 4. Eurogroup, a defined benefit, a service cost component of 300 million has been included in the operating expenses. Okay, that is very dangerous. While the net interest cost of 40 has not been accounted for. That is okay. So they have included 300 million, which relates to the service cost component. Service cost from the employee benefits. Is that an operating expense? It is an operating expense is expense we incur on daily basis to generate revenue. Do we incur that on daily operations? No. So if they had included it in the operating expenses, it means they had understated the operating what? Profit. Add it back. So service cost component, they are included 3. So let's add back. So add back the 3. Add back the 3. Then you check if there was any gain or loss on disposal of any asset. Apparently, this question there was no loss, there was no disposal of any asset. So ignore. I want you to do for me this favor. I want you to go to the P&L, the profit account. Then check where we were having the PBT, profit before tax. It was how much? 23.50. Then here is revenue. I want you to check between this space, the space between revenue and PBT. Any item which was included within this space and it is non-operation. Operations link up for income, only sales revenue. For expenses, cost of sales, administrative, selling, and what? Distribution. So anything you come across here, provided you know it's not part of this. If it was added, you do what? Subtract. If it was subtracted, add back. So let's start from PBT, going backwards, climbing back, going back to revenue. What are you seeing as the first one? Finance cost. Definitely. Finance cost is not an operating expense. Add back, they are subtracted. So finance cost, how much is this? 260. Sorry. Add back. And then share profit of what? Associate. That is not an operating income. So associate profit is how much? 835. Remove it out. 835. Climb up again. Operating expenses. Fine. Actually, we have some operating expense. They combine admin and selling and distribution. So that's okay. Cost of sales is okay. Revenue is okay. That's the end. So can you add? It's as simple as that. Umelewa the trick hapo kwenye naenda. PBT, bring depreciation, assess impairment. Check if there is any impairment that was included. Check if there is loss or gain on disposal of any asset. Go back to the profit account. Check any non-operation. Which came before, not after. Which came before profit, before tax. Simple. So what you get here, you will get cash flow before what happens? Before working capital changes. Cash flow before working capital changes. So what do you get? Before working capital changes? What are you getting? 50? 37? 25. Then bring working capital. Working capital. So working capital, you check inventory. Hey, listen to this. Inventory, receivables, and payables. Increase or decrease. Those three. So hiyo niliwacha kimaksudi. Nasema kimaksudi. So hiyo makosa mnaona mmefanya. Najua mmefanya makosa, si sijui. Msifanye kwa mtihani tena. Najua mjapata. I know. Ama wacha nijaribu nione. Inventory. It is an increase or a decrease? D. D or E? D. Decrease, okay. Decrease of how much? It can be a decrease, yes, but decrease of how much? 4? So physical, wamesema 485. Let me get from online as well. Or CT water. So 485. Online pia nimeona Ugenya 485. But kuna mtu amekataa hiyo figure. The figure has been disputed. So 485 hata kama msiyafanya, that is wrong. 1125 is the correct answer. Nilijua mnafanya hiyo makosa, ni maana niliwacha. Niliwacha kimaksudi ndio ujue what is the issue. 1125 is the correct answer. Okay. Ushachoka. Unaona 1125 ionekani, it's 1125. The way you people are doing 485, you are doing it in section 3 style. What makes this cash flow to be advanced is the acquisition of subsidiary. That is what makes the cash flow to be advanced. So we started with how much? So together at 2060. Yes. Subsidiary came with how much? Check the stock subsidiary came with 640 top up. So take 2060 plus 640. Then we closed with how much? 1575. So it's a decrease of 1125. Umepromise muda sawa hiyo? So you can present it there. You can present it here. Decrease in inventory. So it is not that direct. Ukiweka hiyo direct, you are doing just a normal cash flow. For it to be advanced, we incorporate the subsidiary. So you take 2060 plus, you top up. The subsidiary came with 640. It went down to 1575. And people are saying 11 what? 25. Decrease in stock. Do we add or we less? We add. Because decrease in stock means unauza. You are selling, so it's a cash inflow. So now, with that spirit, now give me receivables. Receivables now will be easy. Do the same. It is still a decrease or an increase? Yeah? Decrease. In or D? D. We started with the receivables, what, how much? 1860 plus 1860 plus 580. So giving you how much? 2440. Then it went down to 50. So that's a decrease. A decrease of how much? Decrease in receivables. Decrease in receivables at the start, 1860 plus subsidiary came with 580, but it went down to 1950. You're saying it's a decrease of how much? For 90. Even that one, we do what? We add. It means you are collecting debts from outside. Please wind up with payables. So wind it up with payables. Wind it up with payables. So wind it up with payables. Online, give me payables, increase, decrease. Alaona ni kusubtract tu basi ni answer. Kitu ya macho. Online, you mean out of these 27 people, no, even no one person can tell me how much? I know you have the answer, but you are hearing. Hapa yenye tumeachiwa kuna issue. Hakuna issue. Ipo sawa. Lea. Kama ujitolee. Unaona online wameogopa. Watu wataki kushekelewa. Umepata ngapi? Increase or decrease? D in. Decrease. Kuna Snyder na is D or E? A decrease. Increase. And before if I use decrease. Is a decrease, it cannot be an increase. A decrease. Yes, a decrease of 125. Najua makosa tena watu wanafanyanga hapo. Unaona hiyo subtraction ya payables. Si ati wewe unafaa subtract. They subtracted to get the net what? The net assets. They took the asset. You know, you cannot add liabilities to the assets. So what they normally do, they take the assets, then they less what? Liabilities. Now imagine hivyo wanafanyanga, it's a way of custom collecting money from you next semester. Wanataka uanguke because of that. That negative is just to collect money. So don't subtract. Don't subtract. They subtracted to get net assets. So what you do, just take opening plus that one, compare with the closing. Sasa wengine wananipea answer after wamesikia 125. Online, sasa sitaki hizo answer. So payables is also a decrease. Decrease in payables. So here they started with how much? 24? 2460. Don't subtract unless the subsidiary was disposed. If the subsidiary was disposed, you less. But here the subsidiary was acquired. So you add. You add how much? 350. Then we close with how much? 26. Giving you 125. Decrease in payables with less. What does it mean? Where kazi yako ni kulipa tu madeni. Accountant should not be paying people. So that is cash out. So you less. So take this plus that minus that. Then you call it cash generated from operations. Cash generated from operations. So online, I'm changing the camera. So it is called cash. Those terms are not a must now. Generated from operations. How much did you get? 1490. Okay, 1490. Now you can pay tax. The human employee benefits you pay. Employee benefits paid, you will pay them actually at the operation. So I will pay tax on the employee. There is employee benefits paid there. So tax paid. Two things. One, for this question, I will do it as a working. Next question, we can do it here because we have understood. Then two, is what? So have outside there taxation, have a working for taxation. Have a working for taxation. So taxation, we want to know how much was paid. To know how much was paid, check the outstanding tax balance at the end. Sorry, at the beginning first. So beginning, what they normally do, another way they collect revenue, right? They bring deferred tax and also they bring current what? Tax. Then most students concentrate on current only. No. You add both deferred and current at the beginning to get your tax obligation. So you say balance brought down. Balance brought down. Can you check deferred and current at the start of the year? Deferred and current at the start of the year. Deferred tax obligation, yes, it is there. How much was the deferred tax obligation at the start? 390 plus current at the start. Current tax at the beginning of the year. Current tax payable 1100. Sure. Meaning that at the start of the year, tax obligation was how much? This plus that. 1490. So tax that had not been paid was 1490 at the start of the year. Having tax obligation at the beginning does not mean you will not be charged for the year. So whatever you will be charged for the year, you top up. So you say here, add tax for the year. So when I say for the year, check your profit account. So check their profit account. And some students, again, they forget about that. In the P&L, how much was the tax expense? 320. Top up. Did subsidiary join with some tax expenses because it will be an obligation on our side? Did they come with tax? Yes. Anything you do with subsidiary back in your mind. So you add subsidiary Subsidiary came with tax worth how much? 50. That is all. So if at all there is no tax which was paid, then whatever you get here should be the value at the end. So can you add? See? 1860. So if at all there will be no tax paid, if you compare closing, it should give us 18 what? 60. So skip one line. Balance carried down. Balance carried down. What plus what? Closing. 415. And the current is how much? 1090. How much is that? How much? 1505. So tax has gone down. It ought to have been 18. But in that 15, they are not telling you that they have done what? They have paid. So the balancing figure is the tax paid, which they are not mentioning. The balancing figure. So they paid how much? Yeah? 355. So they paid 355. That is what the examiner is not telling you. Na kila siku inakuanga hivyo. So you reconcile beginning, during. Sure. Yes. So tax paid 355. Less. The figure for cash generated from operations is wrong. How comes? Did anybody raise alarm? Nobody has raised alarm. So how wrong is it? It is 3725 plus 1125 plus 490 minus 125. Huh? 52. And people copy. Oh, that was working capital. Oh, no, we were adding everything. 5215, no problem. So you just change 5215. Then finally, to wind up, any money which was paid to employees in form of benefits or otherwise, you will subtract it here after your working capital. Once you determine your working capital, that's when you pay employees. So I saw something on employees in note number 4. Let's read note 4. Euro operates a defined benefit scheme. A service cost component of 300 has been included within the operating expenses, while a net interest cost of 40 has not been accounted for. The remeasurement component for the year was a gain of 40 million. Benefits paid out of the scheme were 380. The only problem with that 380 was it paid in the current year, or 380 is the total benefits which has been paid. So that one will make me to reconcile. Apple, let me check non-current liabilities. Check your non-current liabilities. Check your non-current liabilities. Are you seeing defined benefit obligation? Yes, at the start it was 800, then it went by 10. So I want to reconcile. If it comes to 380, then the whole 380 was paid within this year. So I have another working, call it defined benefit obligation. Defined benefit obligation. Defined benefit obligation. Defined benefit obligation. So defined benefit obligation, balance brought down. So employee benefits, the balance at the start was 800. Then go to note 4. Note 4 has so many issues. We adjust so that we check how we can arrive at 10. So in note 4, you operate this a service cost component of 300. So service cost we add to the obligation. So service cost of how much? 300, you add to the obligation. Then, while a net interest cost Salary interest in the answer before service cost by 5. Interest charge of how much? 40, like Apple. Then, while what? The remeasurement component for the year was again of 40. You know, that's actually on gain. So remeasurement gain, the remeasurement gain, they have said 40. So the 40 will reduce the obligation. Sure. Because these are obligations, then there is a gain of 40. So the 40 will reduce your obligation. Meaning that in the scheme, you should have that value at the end. It should be how much? 1100. But according to examiner, the closing is how much? 910. So the difference, reduction in obligation means payment. So the balancing figure here is what they paid. They paid how much? 190. You are paid 190. So 380, maybe some has been paid in the previous year. So now right here, employee benefits paid is an operating issue. So that is 190 question. And you finish, then what you get, call it A. So take 5215 minus this, and tell me what you are getting. What do you get? 4670. Bring it here. 4670. Then you call it A. You call it A. Then now let's go to investing activities. Investing activities. Investing, what did we say you focus on? What is our area of concentration when checking investing? Acquisition and disposal of non-current assets. So when you come to investing, your main area of concentration is on non-current assets. So go to non-current assets. You want to check some small issues there. So non-current assets, which is the first non-current asset which you are capable of seeing? PPE. PPE in cash flow, in a moment, I don't know why this question is only one. There is always the cash paid to acquire PPE, which is a cash outflow, then cash received on disposal. In this question, there was no disposal of subsidiary. So you will reconcile PPE account, but I know you will get, maybe there is one which was acquired. So reconcile your PPE account. So PPE, have it as a working. There is no cash flow you can fail to reconcile PPE. Never. Never, never, never. But very simple, by the way. I'm going to do serious. Just go to PPE. PPE, check the balance brought down. Then you go to the notes. Any note touching on PPE, you adjust. Then you compare with the closing value. As simple as that. So at the start of the year, balance brought down. PPE, opening balance of PPE was how much? 8,800. So leave alone the closing. We go to the notes, we adjust everything relevant to PPE, then we compare with the closing. Note 1, we had a subsidiary was acquired. Sure. Did subsidiary come with PPE? Then top up. So add subsidiary. Add subsidiary. Subsidiary came with PPE was how much? 1,800. Note 2, depreciation. Depreciation we add with less. With less. So less depreciation. Less depreciation. Depreciation we less how much? 1240. We less 1240. Very good. Then the same note 2, there was impairment on PPE. Sure. But this impairment, you have to be cautious. You know, they say there was impairment of 535 was recognized on PPE. Prior to impairment, the group had a balance on the revaluation surplus of 625, of which, so already there was revaluation. So when you less impairment, don't reduce. You remember in the cash flow, we took 535 minus 250. But here we don't reduce to 50 because, you know, prior means before. So that evaluation was already what? There. So Kitoa impairment, it's a net off automatically. The asset had already been done what? Revalued. So that 250 you want to subtract, it had already been captured in the books. So just subtract that impairment. Note 3, goodwill, we don't want. Note 4, employee Fisher. So this should be the closing value of PPE. As simple as your eyes can be able to see. How much is that? 58. What? 80 again. Okay, 88, 25. So if nothing happened means no acquisition, no disposal. It should be 88.25 at the end. However, our able examiner is saying the closing figure is how much? 13,400. So don't wait to be told. That increase means those people did what? What did they do? So they acquired. So acquisition. Acquisition is the BF. Acquisition of how much? 47. 45, 70. That increase. That increase. Are we good? Well, so present it in the cash flow. You say cash paid. Cash paid to do what? To acquire, sure. To acquire PPE. To acquire PPE, that is 45, 75, and it is cash outflow. Kuna watu, they don't care. The students, they don't care at all. hata kama ni minus ama ni plus, zote wanaekanga ikiwa positive. Cash flow hiyo utaroma. You can end up getting, you get the answer correct, but now it was supposed to be added, kama you weke positive out of there. So make sure they want to be subtracted, you have to bracket. There are people who just throw figures. They don't want to know whether it is negative. To them, all of them in their cash flow will be positive. Cash flow is sensitive in subtraction. Next item on non-current assets. Next item is goodwill. Goodwill tulimalizana na mambo ya impairment. Sure. Check the next item. Investment in associate. Here again, very easy. Associate. Why do you invest in associate? What do you get from associate on annual basis? Associate is like a small company where you have small investment. Kama sasa ukiwa na shares of Safaricom, that's an associate company. What do you expect from there? Dividends. So investment in associate, always utilize it in cash flow because they're popular. The only thing which they can change, they can say investment in joint venture. Joint venture and associate one are the same. So use that investment to get dividends. And because it is always easy, we'll do it here. You say dividends from where? Associates. And this is how it is done. This is how it is done. How much was our investment at the start of the financial period? It was 32.50. That was out of the group. We got a initial investment plus post-acquisition profit. So investment can't remain constant. So beginning of the year, investment was 32.50. How much profit did we get in associates during the year? Check P&L. How much profit were we topped up from associates? Check profit account. Share of profit of associates 835. Meaning, when you are closing the year, your investment should be this plus 835. Can you add? If it tallies with the closing, then it means no dividends were received. Hakuna dividends were delivered. So some people pay dividends based on investment. So any reduction in investment without further communication is normally presumed to be dividends. So how much is that? Even you have this and this, 485. And according to them, closing is how much? 39. That reduction is dividends. 39.25. So the reduction in the investment in associates represents dividends. How much? 160. And it's a plus on our side because it's cash inflow. Next item under non-current assets. Once you are done with non-current assets, only two things are done. Two. One, you go to the profit account, you check if there was investment income. Investment income umetoa pale kwa adjustment in operations because it's not an operating income. You will have removed it there. So you remove it from the operations in the adjustment, but you add it back under what? Investing. So that one is not there. The last thing you check, the last one, I want to make your investment investment income. Lakini kwa mtani uko na tani abandika vitu hakuna kwa mtani. Investment income, if at all it was there, it will appear in the profit account. You will have seen it. All right. The last one, I've said two things: investment income. Two, subsidiary. In the question, the subsidiary will either be acquired or disposed. When you acquire, there is something you are paying. Yes. So the amount you pay to acquire subsidiary in the group is considered to be an investment. So the money you pay to acquire subsidiary is a cash outflow, which is classified under what? Investing. Once you bring that investing information. So you say net cash paid to acquire what? To acquire subsidiary. Net cash paid to acquire subsidiary. Walisema, hebu check how we acquired the subsidiary. Note number 1. Hebu tusome your story. During the year, E Group acquired an 80% in S, a local subsidiary quoted security fine. The purchase consideration on acquisition comprised a share exchange of shillings 2,000 million and a cash consideration of 500. So they paid how much? 500. So 500 is the cash they paid, which is cash what? Outflow. Lakini wanashikianga watu miguu kidogo hapo, we should need to be careful. You cannot bring that 500 unless you check. Not unless, until you check subsidiary. The subsidiary which we acquired, did we acquire them with some negative or positive cash? You have to check. Because to the 500 in cash. What about the net assets which the subsidiary came with? Did they come with any cash? Are you seeing cash and cash equivalents? But they came with negative. So that negative, we paid 500 in cash. Now katuachia deni. So what do? Do we subtract or we add? Do we subtract or we add? Your mark is the to say important. Do we add or we subtract? We add. Online, do we add or we subtract? We add request 620. How many people are saying we less? Do we take that 5? The question is simple. It is 5 plus 120 or 5 minus 120. Make kidogo kidogo mdomo inasema kidogo kidogo subtract. Which is which? So Nish is saying we subtract. Alan, what do we do? Some are saying, Mugenya is saying, let's add back. Why are you having? I saw. I'm not going to pay this scenario. Then you don't answer after you put that to your you paid cash to acquire. Rafiki yako amekuachia nyumba. See, in urban centers, the rental houses, mtu anaweza kuachia nyumba. Amekwambia mimi na hama, wewe kuja utake over. Lakini unipee kitu kidogo. Unipee kitu kidogo. So unamuuliza how much? Nakwambia nipe 500. Ukifika kwa hiyo nyumba, unapata token. Token iko na deni. Si token yuko anga na deni. Token iko na deni ya 120. Hiyo ni positive or negative? Cash. Si negative. So token iko na deni ya 120. Wewe umemlipa 500. Na token iko na deni ya 120. How much did you pay ndio sasa uanze kuishi kwa hiyo nyumba? So we add with less. We add. So as a plan that umejitoa yenyewe. So you add. But if it was positive, umelipa 500, ukiingia kwa hiyo nyumba unapata alisahau nia yake mahali kwa draw. That one you do what? You less. So if it's positive, you subtract. Negative, you top up because you're the person to pay. So that is 600 and what? 20. Pusha, measure you. How much do you get? So it's simple. It's all about non-current assets, cash paid to acquire or cash received on disposal of subsidiary. You what? What do you get? Huh? Negative? 7. See me. That's why the question is done. Come on, 45. 45 plus 1 and I think 50. Yes, 50, 35. Call it B. Call it B. Call it B. Let's wind up with financing. Let's wind up with financing. Financing, when you want to work financing in cash flow, you go to equity. Equity and non-current liabilities. How do you financing you work? We finance through what? Through alteration of capital structure and borrowing. So we go to equity, we go to non-current liabilities. You deal with everything which is appearing there as necessary. So let's go to equity. There isn't if tunataka mshike. Tukiwa kwa working capital, current assets, current liabilities. Actually, not all current assets and current liabilities. It is inventory, receivable, payables, prepayments, and accruals. Those 5. But prepayments and accruals, very rare. So the ones which are common, inventory, receivable, payable. Hizo zingine watch kabisa. Hata ukiona financial assets, just leave them alone. Inventory, receivable, payables. You check increase or what? Decrease. When you go to investing, concentrate on non-current what? Assets. Then the money you pay to acquire. When you go to financing, go to equity, go to non-current liabilities. So under equity, the first item you can see under equity is which one? Ordinary share capital. So kila siku, every day inakuanga issue. So wait here, I can show you how to get it. So right here, financing activities. Financing activities. Ukiona ordinary, andika tu kizungu. Cash received on what? On issue. Inakwanga tu issue. Kila siku. Issue of new what? New shares. So you just write that way. Then, should I even waste time to do that working outside? I will just be wasting that time for no reason. How do you know that a company has issued shares? Though examiner will not be straightforward to tell you. Okay, kuna ile 2000 walipeana to acquire the subsidiary, but unajua wakulipa. You know, purchase consideration is never paid for. So what you do, check the closing and opening. The increase in number of shares is issued. That's a minute. So there's a point which I'm bringing home, which is very important. They give shares to acquire the subsidiary. When you give shares to acquire, they are not paying. You are giving them for free so that you acquire their what? Their company. But in your reconciliation, the fact remains the number of shares will do what? Will go up because you issued, though you issued for free. So to know how they got money when they issued shares for cash, simple. Check the opening number of shares and the closing. The increase means they issue. And they don't issue for stones. They issue for what? For cash. So this is what you do. Simple. When we opened the year, so I'm not going to waste your time with the working switch. You can understand. When we opened the year, how many share capital are you seeing there? So electric wanaweka hapo wanaweka premium. Add both premium and share capital together. That is one and the same. So always add ordinary and the premium together. So what plus what? 4,000 plus 1250. So when we started the year, This is what was in our capital structure, 4 plus 1250. However, we gave some to acquire the subsidiary. We gave out how much? It was 2. We gave out 2,000 to acquire the subsidiary. Meaning, at the end of the year, if nothing transpired, our shares should be this plus this plus this. Add and tell us how much? 7250. I hold it somewhere. Can you compare? Don't subtract. You just show me in form of an arrow. Instead of 7250, it went up to 6 plus 2250. The closing. So there's an increase. There is an increase? Yes. Of how much? It went up by how much? 1,000. So it went up to 1,000. It means the issue. Increase in shares are connected in the issue. Jennifer, unaelewa hiyo story? So kitu waliweka hapo ndio mtu achanganyikiwe kidogo, hiyo yenye walipea subsidiary. If they give shares to acquire subsidiary, you add, but don't consider that one as cash. There is nothing they get because they are giving them to compensate them. But the number of shares will do what? Will go up. So add ordinary premium plus what they gave, then check the closing. The increase in shares meets the issue, unless they want to bring some complications. All right, let's move to the next item. Under equity. Under equity, are you seeing retained earnings? Retained earnings is always used to determine dividends. Dividends paid to the parent company. Dividends. Because from your finance, how do you define dividends? What is the definition of dividends? I'm a little definition of dividends. Dividends is defined as the portion of retained earnings distributed or distributed to the shareholders. So it means if there is a reduction in retained earning without communication, then that reduction represents what? Dividends. So what we normally do, you just check, you compare the profit at the beginning and at the end. So the decrease in retained earnings is what? Dividends, unless there is communication, which we don't have such communication. So what we do, simple. What we do is simple. How simple is that? It's simple. How much was the retained earnings at the beginning of the year? But let's capture in our calculator, then we will do it here. It is 2880. Go to your profit account. Go to your profit account, because that was the start. During the year, can you check how much profit was attributable to the holding company? Usichukue NCI. Profit after tax, usichukue other comprehensive. Other comprehensive iko na revaluation. Revaluation is not one. Revaluation hainanga pesa. You check profit after tax attributable to the holding. Profit. I tell you that. You know, profit for the year. Check here. Profit for the year attributable. Profit for the year is 2030. So that is the total. Then from our group accounting, tukishapata profit for the year, si tunagawa hawa tu wawili. So wakigawa hapa kwa hii swali yao, profit for the year attributable to non-controlling interest is how much? So 400. So to get what is going to the parent, subtract, take 2030 minus the 400. Yeah? 1630. Ebu add to the opening profit. Add that 1630 to the opening profit. Kinakuja ngapi? 4510. Na wao wakafunga na ngapi? Wao pia wakafunga na 4510. They never paid dividends. So wacha tufanye hiyo working. Juu nimeona NCI kwa. So there are no dividends. So we are just doing 0.1 here. But it's good to show because of the next question. So andika hapa retained earnings. Right here retained earnings. So for you to get dividends, use retained earnings account. Balance brought down. These people had a balance brought down of how much? 2880. For the year, you said it is 2030, but noisemakers are going with how much? 400. Somebody will ask me, why are you leaving the other comprehensive? No, those other comprehensive are the elements of evaluation and the rest. There is no money left. So we take the profit after year after tax. So 2030 minus 4, 60. But meaning that closing profit should be 40 what? 40 should be 4510. At the end of the year, examiner is telling us closing profit is how much? 4510. So the balancing figure decrease should be dividends. There are no dividends paid. Dividends to holding company, nothing. There is no dividends to holding company at all. You cannot pay the parent company dividends and you leave behind who? NCIs. They will bring a lot of problems. Wanaanza kuongea sisi tunakonga wadogo kwa hii kampuni, tunanyanyaswa watu wakikula dividends. Hata pale tunasema hakuna kitu tumepata, ati tunajua mlipata. So you have to check if you know sometimes mtoto anakusumbua, unajua niseme watoto anakusumbua mpaka inabidi tu. Ukitembea na watoto usikie wanakuambia, mami kwani wewe ukulangi chipo? Ukiresist unakuja na kizungu kingine, inabidi tu unafanya nini? Unanunua. So NCI, let's reconcile NCI account. Let's reconcile NCI account. So you reconcile NCI to check whether they were paid dividends. How much was the NCI at the beginning? You could come for equity. At the start of the year, minorities, what was attributable? The equity attributable to non-controlling interest. How much? 1350. So attributable to them at the start was 1350. During the year, they must be given something. So for the year, walipewa ngapi? 400. So ukijaribu kuadi wanakwambia no. There is a subsidiary which came. So kuna subsidiary ilikuja during the year. Yes, that subsidiary came with some net assets. They are also demanding that. So add subsidiary. Subsidiary came with net assets of 21, 25. Minority will tell you to give them what percentage? 20%. They'll tell you to give them 20% of that. So subsidiary, never forget about subsidiary. That one comes to 500. So what is due to them is this total. 2250. Skip one line. If it tallies, then there is no dividends. According to examiner, how much is the closing for minority? 2,000. A decrease. They were paid. So dividends. Dividends, the decrease. 200 and what? 50. That decrease. 250. That is what they were paid. So let happen. NCI. Dividends NCI 250. Next, under equity, equity is over. Go to non-current liabilities. Go to non-current liabilities. So under non-current liabilities, are you seeing 10% bond? How much, you know, bond is a loan. How much was the bond at the start? Bond was 4,000. Did subsidiary come with any bond? No. If they came with any bond, you add. So we are looking for two things. Is either you acquired more bond or, okay, in a panga, a bond acquisition or bond redemption. But your redemption, you can call it payment. So bond was 4. At the closing, they're saying bond is 55. What happened? They acquired more, and that is cash inflow. So you bring here and you say cash received on issue of bonds. So, 1,500. The difference. That is straightforward. 1,500. Deferred tax tulimalizana. Define benefit kwisha. Once you are done with equity and current liabilities, financing is over. You only check for one thing. The one thing you check, which in the notes I was very categorical, is finance what? Finance costs. Finance costs, we added it back under operations because finance cost is not an operating what? Expense. But finance cost, okay. In the notes I said, even not me, the standard may allow. You can subtract it under operating activities, investing or financing, provided that the company is consistent in classification where you classify. But personally, I feel finance cost. So finance cost wrong. You can subtract it under operating, investing, or here. But personally, I feel finance cost should be subtracted on financing because we incur interest because we are borrowed, and borrowing is severe. So let us say finance cost paid. Finance cost paid. So once you are done with equity and current, just bring finance cost 200 and what? 60. We added it back to rectify, but it is financing. We are done. So can you give me this aggregate? What? I never thought you were going to finish this question. That is wonderful. When you add 1,000 minus this plus this minus that, 980. 1990. That is C. That is C. Bus. So you say here, net cash flow. Net cash flow is A plus B plus C. So can you get for me the aggregate of those three? I never thought that question would come to an end. I'm feeling super what? Super nice. Because now I can give you assignment. When you have the three, the net, you are getting net of how much? 1625, positive. So positive 1625. Nivo. Haya. Sasa unajua cash flow by yake ni inakuwa na answer hapo ndani. So if you are wrong, unajua I'm wrong. So let's reconcile, know them are correct. Hakuna kujango, you know. So you say opening cash and cash equivalents. Then you will get closing. So check your current assets. Check under your current assets. Are you seeing cash and cash equivalents there? Current assets. How much is the cash and cash equivalents at the start? 1085. So to reconcile, to know that you are correct, when you take 1085, you add to what you have gotten, you should automatically get the closing. So can you check before I put my hands? Because how? Correct. So this is 1085. Therefore, closing cash and cash equivalents is how much? 27, 10. We are very much accurate. By the way, for your information, I know, when cash flow is there, mimi najuanga wanafunzi wangu watapata kidogo na kwamba 17 over 20. Ama when you umeona hiyo cash flow na kufanya ingine, it is not very weighty. When you practice vizuri, inaonga 17. Hiyo mtu anapata 17 ni mtu labda alikuja kwa mtihani kama kuna jua mingi na kaongeza sweta nyingine juu. So joto ikamlemea ama kulikuwa na baridi na ana sweta. So alikuwa na struggle concentrate vizuri. Otherwise watu wanapatanga 20 over 20 because you don't need to get everything. Oh, another strategy. Check here. Kusema ukweli hata kwa mtihani mimi nikipata hiyo kitu haita balance because of time. You know when you are rushing, you know here ina balance vizuri because we are many. Tukiadd, si kuna vitu tulikosea hapa. So kwa mtihani unaweza kosea hiyo hivyo, so it is very possible. So ukikuja hapa ukiadd a plus b plus c unapata -1. Na kusema ukweli unaangalia -1 plus 1085 cannot give you what? 2710. So always make sure nobody will mark you wrong. Make sure you finish with the correct answer. Hii pia umeweka. Na unatumia strategy. Something plus 1085 must give you 27 what? So you fix that sum. Tunaelewana? So a plus b plus c ufanye kando. Unaandika kwa hiyo blue. Inakuwa green ama blue hiyo karatasi ya gas. Sisi ndio colors. Ni blue ama ni green? Blue. Andika kwa hiyo blue, you are a plus b plus c. Ukiona umecompare na hii ingine na hii gani? Sema x plus this is this. Fix that x 1625. Akipange huko ndani. So our next question, two things. I want a question with the disposal. This was acquisition. So I want where subsidiary has been disposed. And also you will remind me, we do a question, this is indirect. We do a question with indirect, then we repeat using direct method. Then we will be safe. Because here they dictate the format. They will tell you use indirect, use direct. So in the next class, make sure you tell me to repeat using the two methods. But it will be easy for me if I leave this assignment. One time when I so that when we are together, we can move fast. Sure. Check for me this question. Ikuja ama isikuja hiyo cash flow? Uje. So tunaandika profit before tax. Who cares? So, anakuja swali hapa. Na mtafanya assignment kweli. Atilele tu. Whether done or not. Hii siku hizi watu wamemea. Unajua kuna watu hapa tukianza diploma nikopea assignment walikuwa nafanya. Mpaka wanaleta for marking. Siku hizi. This one is page 64. I want to rectify. Mogenia, what about cash and cash equivalent of the subsidiary? No, you ikujangi hapa. That one we check when checking the cash we receive, and that is the end. Open that page 64. I know that question. There's something I want to rectify. Are you there? Page 64. I check page 65 of it. Check page 65. In page 65, are you seeing trade receivables? Are you seeing trade receivables? How much? 3120, 3170. That was there's a mistake. That 3170 should be 3120. It was the same, 3120, 3120. Ni CCAS name, whoever was making our papers, hata ukiadd ndio utapata hiyo figure. So 3120, 3120. So this is disposal. So I want you to try, let me make this clear. I want you to try what you do. There is no difference between disposal and acquisition at all. The only difference, unaona kwenye tulikuwa tunaongeza, you now do what? Subtract. Where you are starting beginning plus subsidiary. Now you take beginning minus the subsidiary. So it's just the same. So just where you are adding, you subtract, then you check. Thank you. Do have a nice day. We are 6 minutes past time.
But cash flow wataleta. And that is one question utapita nayo. Lakini ikiwa kwa